Now, the Fed is most definitely in a trap. And why? Well, the Fed's attempting to tighten monetary policy, as we all know. But relatively few people out there realize that this will be impossible for two very powerful reasons. Now, we all get stuck in our own little circles, and it seems like everyone we're talking to or maybe talking to realizes that the Fed is trapped, but this is not a widely held understanding. And even in our own circles, there's one primary reason why everyone feels that the Fed is trapped, but there's another one that I think is escaping most people's notice, and I'll get into that in a moment. But first, the reason why the Fed simply can't tighten or can't normalize to any great extent monetary policy is addicted markets. We've had years now, many years of ultra easy policies, ever loosening monetary policies. And these have created over time a towering financial house of cards. The bottom line is that markets are not just addicted to easy money. Everybody knows that, but ever easier money. In other words, they are addicted to this monetary adrenaline. And like an addict, they need an ever greater dosage of the drug of choice to get the same effect. Let's examine this a bit. First, easy money builds bubbles. This is not a bug. This is a feature of the policy. This is exactly the intent. Post 2008, it was stated as such. Easy money was going to recapitalize the financial markets, primarily real estate markets, primarily equity markets, and to some extent the bond markets to continue that decades-long bull market in bonds. Here we have the S&P 500 versus Fed assets. As you can see, the black squiggly line is S&P 500. The blue line is the Fed assets, the Federal Reserve's assets that they built up and that they built up in every crisis. What you'll see here is QE1, QE2, Operation Twist, and Unwind, and QE3, all marked by the shaded areas. Notice that there's a correlation coefficient of over 90% between the S&P 500 and the buildup in Fed assets. The effect is undeniable and it's purposeful. Easy money builds bubbles again in home prices. Here you see in blue the median home price. In red, you see the Fed balance sheet. You can see particularly after the onset of the pandemic, that last yellow shaded line, the effect was almost instantaneous and obviously a one-to-one correlation. Median home prices, as everyone knows, have soared because there's just so much money out there seeking to find a home, pardon the pun. Now, this policy goes back decades. We can look back into the 1980s when it really started post-Volcker, when every little hiccup in the economy, even a perceived or possible potential hiccup in the economy, much less any real recessions, was greeted by a campaign of lowering interest rates by the Fed. That was the recipe, that was the policy, standard operating procedure. So you see that in each instance, the Fed lowered rates, and then when it tried to normalize rates, it could not even normalize rates back to the midpoint of the previous range without the markets telling it to stop and reverse, and the economy, in effect, telling it to go back. So that it started on the second floor and went down the steps, hit the basement or hit the foundation in 2008, and again, tried to take a step upward, but went right back to the foundation. If you follow this trend, we go into negative rates, which this trend says would be the next step. And it's certainly something that cannot be ruled out. And in fact, if you parse the words of the Fed officials, they have not actually ruled it out at some point. We'll see, because the record shows we are going to have another financial crisis upset that will prompt the Fed to go back to an easy money policy. As I'll show you in a moment, that doesn't appear to be too far in the future. So these low rates over time, the steady, ever lowering interest rates, now just bounded and right at rock bottom at zero, they also encourage the buildup of our second factor that will prevent the Fed from tightening interest rates, and that's unmanageable debt. Years of managing interest rates ever lower in response to economic slowdowns, real or imagined, fostered the creation of towering debt loads that are absolutely unmanageable. I could go through a lot of charts, and in longer presentations I do, but I think we all have a very good understanding of how large the debt is. But let's just go through a couple of charts. This is a chart by my friend Ron Grease at thechartstore.com. Does a lot of our charts for my presentations and Gold newsletter, and I highly recommend their service. But this is a chart of gross federal debt that I used last fall. And as you can see, I'm using this older chart to make a point here. As of September 30th, the total debt outstanding was $28.42 trillion. Now, the trend line growth, and this is something that Ron does, that's great. He plots the trend line growth of the federal debt back to 1900. This is even predating the Federal Reserve. And even though it predates the Federal Reserve by 13 years, the trend line growth rate is 8.7%. Now, imagine if you could invest in something that compounded at 8.7% every year over time. That is the federal debt in the United States. It's constantly growing. Only the speed is in question, and its average rate is 8.7%. Now, back then in September, you can look at the second commentary down here in the chart. If gross federal debt continued growing at that trend line growth rate, that very high growth rate, it would reach 30 trillion by May 2022. Well, the fact of the matter is that kind of a number sounds amazing when you present it to an audience, but it is almost invariably conservative. Right now, we're at $29.8 trillion, just a whisker away from $30 trillion in federal debt. And so we're going to beat that May projection that was made just a few months ago. We're going to beat that by a considerable margin, time-wise, and in absolute size of the debt. You can see that the actual federal budget deficit for this year is right at $3 trillion. And if not for 2 votes in the US Senate, it would be closer to $6 trillion. So that's how out of control the debt situation in the US is. But there are implications to this. The primary implication is that it presents a brick wall in the way of the Fed from ever normalizing rates or getting anything close to it. Now, this is something that you won't see everywhere else, and I think you only see in my presentation. So let's examine precisely how firm and how near this brick wall is. Now, this is a chart of federal debt and Fed interest expense taken from the Federal Reserve website itself. You can see the blue line is the federal government current expenditures for interest payments. This is what the federal government is paying to service the federal debt on an annual basis. So that's the blue line. The red line is the federal debt held by the public. Now, I'm using the lower number here because obviously when the federal government pays itself interest, it is a net transaction, a net zero transaction. It zeroes out. So we're only looking at federal debt held by the public here, a more conservative rating of the federal debt. And as you can see, the blue line, interest payments, varies. Even though the federal debt is constantly growing, the interest payments fluctuate because, of course, the interest expense is largely dependent on the interest rate. So let's zoom in on that crossing action that we have at the end of this to look at this a little bit more closely. Here we have from 2012 on to current date. And that area that I've circled is basically December of 2015. This is the first Fed rate hike post 2008. And as you can see, even though they were only, remember back then, they were raising rates at the rate of just a quarter point per year. This is how quickly Yellen was raising interest rates. It was just tremendously slow, yet even at a quarter point every year, you can see the effect of even moderately higher interest rates had on that blue line, which is interest payments. It soared from about $480 450, 480 trillion a year to nearly 600 trillion a year very quickly. And again, this is at just a quarter point a year and increasing. Conversely, at the end, they dropped off because interest rates fell to zero post the pandemic crisis. So the interest expense is tremendously dependent upon the interest rate. Now, here's where we get into some information you won't find anywhere, because hardly anyone, and in fact, no one that I've seen actually calculates the interest rate on the federal debt at any point in time. They all say it's very hard to calculate all of these different maturities. It's a moving target. You can never really know to any degree of certainty. So I went back and just simply divided the interest payments by the federal government, by the federal debt, to get an effective interest rate, a simple interest rate on the federal debt. And that's the blue line you see here. Now, the red line is the Fed funds rate. Now, you can see that the interest rate on the federal debt generally runs 2 to 4% above the Fed funds rate. That spread may narrow for a very short time, but generally it's 2 to 4% above the Fed funds rate. So let's be conservative. Let's say that the effective rate is only 2% above the Fed funds rate, and look what we get. This chart shows the effective interest rate assumption at various rates. So again, I've highlighted 4% because I see that the Fed's barrier here, the limit that they can raise the Fed funds rate, is at most 2% on the Fed funds rate in this tightening cycle, because that would imply an interest rate on the debt of 4%. And that would imply an annual debt service cost of $1 trillion, kind of a magic number that I believe the public just won't accept. There is a political environment right now where there's a lot of money being thrown around and a lot of programs being searching for money. And in that kind of an environment for the U.S. to be paying $1 trillion a year to fat cat hedge funds, bond investors, foreign entities, even China, when that money could be used for universal basic income, free college tuition, et cetera, in a litany of entitlement programs, I don't think that's going to be politically palatable. So well before the Fed gets to a 2% level on the Fed funds rate, and maybe at 1.5% or thereabouts, we're going to see them forced to turn backward. If not because the equity markets and housing markets and bond markets will be crashing, but at the bottom line, because the debt costs, the debt service costs simply would overwhelm the budget and not allow them to go any further. So what are the implications for gold and everything else? First and foremost, the underlying currency, the US dollar, must be devalued. And of course, most every developed country in the world is in the same situation with unmanageable debt. So they will be devaluing at the same time. And this is the recipe that's been used throughout time. The Romans did it, the Greeks did it. Every civilization in human history has at some point rung up debts that it could not manage and had to devalue its currency. Here you see how the silver content of the Roman denarius was devalued, debased over time, and as these debts ran out of control until it reached zero. Now, this is something that's not foreign to us. It's actually happened in the U.S. Here's the purchasing power of the U.S. dollar going back to 1965, when the government took silver out of U.S. coinage. The dollar has been progressively devalued more quickly in the 1970s and at a more muted pace in recent decades, but still an ever devaluing currency. And at this point, during the lifetimes of most of us watching this presentation, the dollar's lost about 89% of its purchasing power. I think that line is going to accelerate to the downside very shortly. Now, how do you protect yourself? Obviously, gold responds to this by rising in value. It doesn't rise on a one-to-one ratio. If you want an asset that actually follows the CPI, you have to invest in energy or in oil, because it's actually a component of the CPI. What gold is insurance against the depreciation of your currency. So when people get worried in the 1970s, post 2008, and in what I believe will happen in the next few months, when people get worried about the purchasing power of their currency, they buy gold, and gold makes up for lost time and, in fact, overshoots to the upside. So this is how gold responds generally, lower left to upper right, as a currency is being depreciated, with some periods where it really accelerates to the upside. And I think we're approaching one of those periods now. Another implication from all of this is that real rates must be negative going forward. The interest rates subtracted or adjusted for the inflation rate, subtracting the inflation rate from the interest rate, is how you get real rates. And negative real rates are an incredibly bullish environment for metals. Here we see that real rates, if you use them, if you deflate them by the CPI and not by Wall Street's forward-looking inflation expectations, but the real rate of inflation is measured by the government, the CPI, you can see that real rates right now are at the same levels we saw in the 1970s. So we are already back in the 70s in terms of inflation and the impact on interest rates. Now, there are some big differences between now and the 70s, obviously, but the two primary ones that pop to mind are, one, that's in the 1970s, we didn't have the kind of massive debt loads that we have today, debt loads that preclude raising interest rates to fight inflation to any great extent. So the Fed is going to attempt to fight inflation, but it doesn't have a fire extinguisher. You cannot put that fire out. It is in fact impotent to do so. The other big difference is there's no political will to fight inflation or to raise interest rates or to loosen money or tighten monetary policy. In short, there is no Paul Volcker around today. You can look all you want, but there's nobody with that kind of political will who is going to be in charge of the Fed and try to fight inflation. Gold loves negative real rates. This is a wonderful chart that I keep going back to from our friends at Incrementum AG, who published the In Gold We Trust report. Now, these blue shaded areas, as you can see, are areas when in negative real rates pertain. The blue shaded lines are interest rates, real rates, and the gold line is gold prices. As is apparent, gold loves negative real rates. It's not that you can't have some downturns, but gold generally is in a bullish environment when there are negative real rates. And from the way I see things, we will be in a negative real rate environment going forward, unless there's some great monetary reset. As long as we're under the current monetary regime, we will have negative real rates. So where we are now, this is a chart that I like a lot. I use it in Gold Newsletter a lot. It's actually gold with this 14-week stochastic, which is a momentum indicator. As Ron Grease notes here on the chart, the indicator is very whippy right now and inconclusive. So there's no firm upward trend. And we all know this, who all of us are investing in this sector. We seem to go 2 steps forward, 1 step back, 1 step forward, 2 steps back. And the gold price can't get any really sustained upward momentum. These areas I've circled on stochastic are similar periods where that stochastic was whippy. And as you can see, they usually, in the early 2000s, they preceded periods where we had long runs upward in the gold price. And then following that, we had a period in December of 2015, which marked the bottom of the long bear market. We had a nice 6-month run in gold after that. And that brings us to our final chart, where we will be soon. This is a chart just put out by the Gold Institute, World Gold Council. And as you can see, the first chart shows gold in the gold bar 1 year before rate hikes, and gold doesn't do that well. 6 months before a gold rate hike, gold's actually negative. But in the 6 months afterward, in the 1 year afterward, gold outperforms other asset classes. And I think that's exactly where we are right now. Once the Fed begins raising rates, as soon as March, probably as late as May, then I think that will mark a bottom in gold, and gold will be released from the selling pressure and start on a nice, at least 6-month long bull market. It may happen before then. It may not. The past track records show that gold typically weakens going into the first rate hike, so that may happen as well. But we are in the end game. We are only, I believe, just a few months away from gold being released by the Fed rate hikes. So thank you. That is my presentation. You can follow my work at goldnewsletter.com. You can come to the New Orleans Investment Conference this year from October 12th to the 15th. And you can follow me on Twitter at Brien_Lundin.